You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
I'm Sam Ball with my co-host John McEwen. Thank you for listening to episode 0 of The Investor Way. What we want to do in this episode is just talk a bit about ourselves and why we've created the podcast. But yeah, this is very much just an introduction episode, just to get a taste of it, really.
Hi, my name's John. I'm a junior doctor working in Oxford, and I first became interested in investing back in 2013. It started out largely as UK defensive companies with a value focus. And after reading and learning more about investing, particularly after reading Professor Malkiel's A Random Walk, I became more interested in investing in index funds, which is now where I put the largest allocation of my portfolio to. And it's global equity, but particular focus on the US. The other parts of my portfolio that I've relatively recently starting adding to is commodities, and really as a hedge against inflation. And that was after reading Andrew Craig, How to Own the World. And I'm doing that regularly now through a free investing platform, Trading 212, and essentially dollar cost averaging the commodities index.
What proportion of your portfolio do you think is in individual stocks now?
I would say in terms of individual stocks, it's probably about 50%.
I'm surprised it's that high, actually.
It's about 50%, and that's probably just because what I had left. And when I initially started investing, I put most of my cash in one big lump. I hadn't really come across the concept of dollar cost averaging. And when I came across that, and that you could sort of, I suppose, reduce the sort of volatility of that portfolio, I think of it as, rather than reducing the risk, but reducing the volatility, then it's taken a while to just build the rest of the cash into the portfolio and essentially into the index funds. So that's why it's taken a little bit longer. But now it's probably about 50-50.
But it is going down, basically.
It's going down.
Okay.
And I've really been using, in the UK at least, the Vanguard platform, because if you're buying the Vanguard index funds through the Vanguard platform, there's no charge that you get with the other online stockbrokers, but it does limit you to the Vanguard funds.
They're the cheapest, though, aren't they? Usually,
they're pretty much. I think the other ones that would come close, BlackRock, are pretty good, but in the UK you don't have sort of a BlackRock platform, so you'd be buying them through online stockbrokers. And I suppose now we're quite lucky in the UK, at least, because we're getting some of the free or no fee platforms coming through. So Trading 212 is one of them, Free Trade, and I think there are a couple of others. Robinhood didn't end up coming, but there are some pretty big players which make the cost of investing remarkably cheap.
I'm Sam Ball. I am a trainee accountant in the northeast of England. And I first became interested in investing when I was at university. So I started with my student loan in my third year of university and invested that. I had a very, very good first year, which I'm yet to beat, actually. Although that's more because I didn't understand diversification and things like that. So I had a very concentrated portfolio, and it just happened to work out well for me. But I had a very good first year, and on the back of that, I did a TED Talk it was actually a couple of years later, I think maybe. In 2017, I did a TED Talk on investing. And then now, in terms of my portfolio, I've got my pension set to go into index funds, so I can just leave and forget that. And then my individual portfolios outside the pension, it's all in individual stocks. So I don't have any index funds outside the pension. in terms of the individual stocks, it's about a 50-50 split between growth stocks in the US and UK value stocks. Although the UK stocks, I'd say they're more value just because that's the nature of the market in the UK. It's not really something that's deliberate. And then I've probably got about 10% of my portfolio in Bitcoin as well, which is something I became interested in about 2017, just before the big run up. Although unfortunately I didn't benefit from that as much as I could have done. So I bought a load of the altcoins in 2017, and I got them just before the big run up, and I pretty much rode them all the way up and then all the way back down. And as I learned more about it, I realized that the only one I actually believed in was Bitcoin. So now I just hold that.
I was only going to ask you about, it was quite interesting that you've got a large allocation to US tech, and then also by the sounds of it, a sizable allocation to UK. And why in particular do you have those two markets?
It's more to do with availability, right? So I do think that I don't know where, but I think between 40 and 60% of your portfolio should be based in your home currency. That's my, just because of things like exchange risk, really. I wouldn't ever be comfortable with the I wouldn't rebalance, but in terms of the actual contributions and amounts invested, I wouldn't want over 50% to end up going to the US. Just because if we had depending on the exchange rate, I mean, you could make 10 or 15% in a year, which is a very good return, and the exchange rate could wipe you out. And I think if that's 100% of your portfolio, that's not something I'd really be comfortable with. So that's why. In terms of the US, it's just because I do like the high growth tech stocks, and I think there are some really, really good businesses. But that's pretty much where they are. If you want to invest in those, you do have to go to the US. I'm not really aware of any other markets that are like that, or I probably would look at them. Because I mean, even in the UK, we don't have much of a tech sector.
No, we don't. And I saw that recently NVIDIA over in California has I think in the process of buying it back from SoftBank. And that, I suppose that was one of the tech gems, but that was sort of taken over back in 2016. And what else would you say? I suppose you've got Rightmove, Auto Trader.
I saw. I've never looked at it, but I was looking the other day, and I saw that Trainline's actually listed.
Okay. Oh, yes, of course.
I don't know anything about it though.
No, Trainline. Have you not used it?
I've used it, but in terms of
as a company
for this podcast, actually, I was just I was subscribing to updates on all the different FTSE companies. So I went down the full FTSE 350 list to find ideas, and I was just like, Trainlines. I've never looked at Trainline beyond that. So it's something I would look at, but I don't know I don't know anything beyond that. So I will have to.
No, that's right.
There's Just Eat as well, but I find that less attractive since it's merged with the takeaway.com.
And is that a Dutch-based company?
It's Dutch. It's still listed in the UK, it looks like.
Okay, yes.
But then they've also announced the acquisition of, I can't remember which one it is. Is it Grubhub in the US?
It could be. Yes, I think that's right. My
understanding of Grubhub was it lost a lot of money. It doesn't make money. Whereas, and there's talks of like synergies and stuff, but Just Eat was actually profitable.
Yeah,
it was a decent size, and when it was listed on its own for about 5 billion market cap, I thought it was something I'd always had on the watch list.
Yeah.
I suppose
it'll have a lot of competition with Uber Eats and well, particularly Uber Eats. But we've got Deliveroo over here, which I don't think has a US presence at the moment.
So I find that I'm not really interested in that anymore. I think I did own it for a small period. I think I bought it and then pretty much immediately after, that was when the merger was announced or the offer.
Oh, I see.
And it jumped about 25% literally the next week. So I just sold it.
You sold on the news.
Well, I didn't particularly, if the offer did go through, I didn't want to hold the shares of the combined company. So I thought there's no point waiting for it to go through. I may as well just get out now.
Sure.
But it's annoying because I would have liked to have carried on owning it on its own.
Okay, yeah. So I guess that was one UK tech stock, if you can call it that you did invest in.
Yeah, but a lot of the businesses I look for in
there's-
the US, they're very capital light businesses.
Okay.
It's like, I know it's Latin American, but Mercado Libre is a good example.
Yeah.
I'm trying to think what else.
So
Like Etsy as well.
Okay, Etsy, yeah.
So it's almost like creating a platform, and you've got this capital light business, and it just allows you to scale so much more. And I think when you get later down the line, these companies can be insanely profitable. But I mean, I'd say if anything, the FTSE it's very capital intensive. You are talking like oil and gas and pharmaceuticals and stuff like that.
Yeah, no, that's right. And I suppose, and banking as well, of course, which hasn't been doing very well in the last, since coronavirus, and it was looking slightly more positive after the election of a majority government in the UK. But we know what's happened with coronavirus and everything being knocked off since. But
have you seen Lloyd's is down to like 25p a share now?
Yes, that's right. I mean, what do you think of some of the domestic UK banks as
it's hard because one thing I liked about it was going into this crisis. I thought the banks, they were well capitalized, and they were actually being well run. And then to deal with the crisis, the government's essentially, it's forced them to suspend their dividends and make a load of bad loans, a lot of which will be covered by the government. But I definitely like them less as a result of the intervention. And they were primarily, like, they were an income play, really.
Yeah, people potentially put their money in Lloyd's shares rather than in a Lloyd's savings account.
Exactly, yeah. So, I like them less now than I did in February, March. But I've got RBS personally, and I've not sold it, but I certainly wouldn't be adding to it.
No. I mean, do you think it's coming into the sort of territory of being a value buy or value play?
I think it must be, because like when I saw something, it was a few weeks ago now, but I think historically UK banks, they've traded at about 80% of the book value, and at the minute on average they're about 30% at the minute. So even though historically they do trade under book, they don't normally trade this much under book.
It's not just a book. So what do you think in terms of the outlook then? I mean, investors are obviously pricing in a very torrid time ahead.
I don't know. Like I said, I'm not buying anymore.
You're not buying anymore. No.
Yeah.
I suppose there's Brexit on the horizon, but we don't yet know what that, what form that's going to take, or just the UK more generally as sort of the coronavirus pandemic continues. Yeah,
we've gone off on a bit of a tangent there, but we were gonna talk about why we'd created the podcast. So I'll do that now. What is basically in the middle of it. Yeah. So in terms of why we've created this podcast, I think we both listen to a lot of podcasts when we're driving and whatever else we're doing, and I particularly find that there's a lot of good podcasts available. But in the US, it's very easy to find the sort of podcasts that I like to listen to. Mm-hmm. Whereas in the UK, it is something that I struggle with. I don't think I'm not aware of any podcasts where they're talking weekly about UK stocks and shares. I don't know if you're aware of any, but
I think there are a few. And it varies in terms of, some of the focus is probably more on personal finance than investing
the AJ
itself.
Bell one. I like that. That's very good, but it is generally a lot broader. So they might talk about what the markets are doing, but they don't really delve that much into individual companies.
Yeah. So perhaps there's sort of lots of personal finance and then some of the bigger macro ones, but nothing on sort of individual stocks and shares from a UK perspective.
So we've got a couple of companies that we want to cover this week, and then we'll see if we've got anything else we want to discuss at the end.
Yeah, sure.
But the first company I wanted to talk about was Peloton.
So tell me a bit about that, Sam. So
how much do you actually know about it? Because I can't.
So I know very little. I know it's US tech, and it's sort of would you describe it as esports?
Oh no! So do you know the bikes? Have you seen the bikes that people are getting?
Yeah, I've seen the bikes. I think So
you spend like $3,000 on a bike, and it's basically got an iPad on it.
Yeah.
And then once you've spent your $3,000 on the bike, you might spend like 20 quid a month subscribing to fitness classes, where it's like
Via
you're
the
almost getting
bike.
like zoomed in. Yeah, so they
Okay.
show up on the iPad on the bike. So the idea is you're like more motivated. And it's like you're able to then exercise on your own at home, but you still get the communal benefit of being in like fitness classes with people.
Okay. And when did they launch? When did they go public?
They only went public a year ago. So it was actually September last year. So they went public at a market cap of about $7 billion.
Oh, so it's pretty sizable.
They're just under 24 billion now.
Okay.
So
it's yeah.
It's over 3x.
Yeah. So yeah, and was it sort of through the roof on the IPO?
No. So it IPO'd at about $24-25 a share.
Okay.
It looks like it went up by the end of the year. So within about 5 months, it had gone up to about $36 a share.
Okay.
And then it's sort of hovered around the 30 range. In March, it dropped back down to 20, and then it's just been like everything else since then, like US tech stock. It's just gone straight up since then. Basically,
it's taken off, has it? Yeah.
Yes. So since then, it's up about 4x from its March low.
Okay.
Or over 4x.
Okay. So, and what do you think? What do you think of the earnings? Do you think has it been justified?
See, that's what I'm not sure on. So they had their earnings last week.
Yeah.
And in fairness to them, they did absolutely smash it. So for Q4, total revenue grew 172% year on year to $607 million for the quarter. For the full financial year, total revenue grew 100% to $1.8 billion. Now, I just think if you take the 1.8 billion and you look at the 23 billion market cap, that's still quite expensive. But it's not. So they've also said that they're expecting about 3.5 billion total revenue for 2021. So if you put it on the 2021 sales, if you assumed it is going to hit 3.5 billion, it's got a price to sales of just under 7.
Okay.
Which is it's fairly reasonable, but you are assuming the 2021 sales.
I was just going to say, and how much do you think that lockdown impacted on? Do you think that sort of there was a surge, or do the company attribute a surge in sort of bike purchases down to that? And is that something that's likely to be replicated?
Yeah. So growth has massively accelerated because of this. So there's a little graph in the earnings report they've got where you can see that it's even the work. So the average monthly workouts per subscriber is just under 25. In Q3 it was 17, and Q2 12.6. So Q2, the start of Q2 really is when we got coronavirus. So that's when people are ordering their bikes, isn't it? So from people starting to order more bikes and coronavirus, it's basically the number of monthly workouts has doubled.
For a longer term picture, whether people are going to be returning to gyms. I mean, I haven't looked at any of the sort of gym groups or companies that have been sort of reporting, but whether that's sort of now more of a longer term behavioral trend to work out from home. And I suppose if you've put up that investment and bought gear, including the Peloton bikes, to work from home, maybe you continue that.
I think so, because I think people going back to gyms would impact the new purchases. I don't think if you spent $3,000 on a bike, you sort of committed to that.
I certainly would be.
Yeah, which is. Yeah. But then if you look like within 6 months, the average number of workouts people are doing on it has doubled, and you would expect that to come back down. I suppose the argument is as long as people are continuing to use it, they'll pay the monthly subscription. But I imagine when you're doing 24 workouts a month instead of 12, you're more likely to carry on subscribing because you feel like you're getting so much more use from it.
No, that's true. And are there any other competitors in the market?
I think there's small ones, but I think I'm not aware, but that doesn't mean there are.
I mean, to me, it sounds like quite a unique idea that you.
But then, if you look at it as a price to sales, the full year sales for 2020, they're expecting 1.8 billion. So that puts it at a price to sales of 13. The problem is with the price, for me, with the price of sales being that expensive, I think it needs to have, firstly, it needs to continue the growth, which in fairness to them, growth is accelerating. So although you wouldn't expect it to carry on growing at current levels, there's nothing to suggest it won't do the amount of growth that's priced in. So for me, the issue is the margins. So the gross margins and the operating margins need to be good enough that when it does stop growing, it is this massively profitable business. And that's where I struggle with it. So
yeah.
So at the minute, the Q4 gross margin was 47%. That's quite low, really, I think, when it's priced as a technology company. But the reason for that is because they don't make as much money on the bikes, because the idea is they're selling you this subscription.
Okay.
So the actual subscription gross margin is 64%. So if you buy into this idea that they're going to sell all these bikes and everyone's going to carry on subscribing, that has 64% margins. So once you get to the point, once that makes up a larger proportion of revenue, that should start to pull through.
Okay. So in terms of the stock itself then, are you interested in buying any at the moment, or is it something you'll watch and wait?
It's a shame, I think, because it's one where when it first came public, I did have a look at it and I discounted it straight away.
Did you?
I just thought it was one where like, why is someone going to sit at home on a bike with an iPad in that's cost $3,000 and subscribe like 20 quid a month? I just didn't really get it.
Yes, yeah. You didn't buy into the
No, and then we had the lockdown, and I think Piers Morgan got one, which it's like you saw people on Twitter getting them, and like Piers Morgan got one, and
have any of the celebrities been sort of buying the Peloton bikes? Or
I've only seen
Instagram
Piers Morgan get one, but I've seen a few people on Twitter have got them, or they've said like their wives have got them or whatever.
Sure.
And once I saw that, it did sort of click a bit more, but by then it's just been going straight. Like now, looking at it at a 23 billion market cap, I don't know. How much money is it later down the line? How much money is it going to make? Because it needs to grow a lot. There's a guy on Twitter who's definitely worth following. He's a guy called Puru Saxena. So he's a retired money manager, basically. And he's based in Hong Kong, but he invests in very, very high growth stocks. And as soon as the growth numbers start slowing, he just ditches them.
And is he someone who's bought a Peloton bike or bought Peloton stock?
So he did a tweet talking about the earnings, and he generally only invests in high growth companies, and he's very, very good to follow. But he's talked about the earnings quarter, and he's given a little breakdown of it, and he said very strong growth, 172% year over year. The hardware growth has increased by just under 200%, and the hardware revenue makes up 80% of total revenue. Subscription revenue has grown by just under 100%. Subscription revenue only makes up 20% of total revenue, which is unchanged. So he said it's primarily a hardware business and he doesn't have a position in it.
Okay.
And I suppose you'd need to wait and you'd need to give it a bit more time. But the fact that subscription revenue isn't going up as a proportion of total revenue, I'd be inclined to agree with that. Yeah.
So it's one you'll continue to be on the watch list. And see how things go with it.
Yeah, I do like it. Well, I don't know. The time to buy it was 6 months ago, wasn't it? Really, I think.
Well, yeah. I mean,
will you be buying it?
Probably not. But I mean, I'm much more now in sort of investing in index funds, and
But you don't see yourself on a Peloton bike anytime soon,
probably not. My gym membership, I have actually returned now, and it was more normal than I thought since since the sort of restrictions of coronavirus sort of came in. So actually, the gym is open. You can go swimming, you can play tennis. So I'm actually back now. I was wondering after sort of finding alternatives over lockdown when the gyms were closed, but no, I'm back going to the gym now. So I don't think I'll be buying a Peloton bike.
Okay. They are expensive as well. I'd imagine the number of people that will spend $2 or $3 grand. They have introduced a lower model actually.
Really?
Yeah.
And it does, I mean, how much of it is a phase, a fad? I don't know. Will people be riding the Peloton bikes in 2 years?
I think if they could get a bike out to you for a few £100 and sell you the subscription for 20 quid a month.
Yeah.
I think it makes a lot more sense. But when so like they brought out a cheaper range of bikes now, but even the cheapest one, it's probably like, I don't know, it's like $2,000, so maybe like 1,500 quid.
Yes,
it's still still expensive.
It's a big one-off purchase. Yeah. Not for me.
No. Yeah. I do like it. I just wouldn't buy it. Yeah. It's an interesting business though.
Okay. And did you had another one for this week? Games Workshop.
Games Workshop. Yes. So have you?
See, and this is a company that you do like.
Well, yeah. So do you follow Games Workshop much at all?
Not particularly, but I know that it's been performing very well in the last few years.
Yeah. So the share price, even about 3 years ago, it was about £15 a share, and I think it was even lower. It's absolutely shot up in the last few years, but now it's just over £100 a share now.
It's over 100. Oh wow,
100. Okay. Yeah.
And how's it got there?
So they're selling. I know they're selling more online.
Okay.
And then they've also did you ever have the metal ones?
Yes. Yeah. I mean, there's plastic, metal.
It's all plastic now. I think my understanding it's really as a result of just being quite well run. So if you look at the financials, in the last 5 years, revenues increased by 128%, which is pretty good. But operating profit has increased by 433%.
Okay.
So it's more of a margins thing, isn't it? So they're obviously getting the cost down and they've got better margins on what they're selling. Yeah. So they had their August results, which they published on September the 10th. Yeah, so for the 3 months to 30th of August, sales of 90 million versus 78 million in the period last year. Operating profit is 45 million, so 50%. It's compared to 28 million in the last year. So they've said this has been driven by healthy growth in our online and trade channels. However, our retail,
of course, the retail shops are must have been closed for a couple of months at least.
So I don't know if that means that more people are going online who would have bought in store at lower margins and will possibly go back to buying in store afterwards. So it just looks like a really, really well-run business. I think the product's very sticky as well. In terms of someone else could launch a rival, but you're not going to switch really, are you? If you're already collecting Warhammer and your friends are.
Yeah. And they've got the books. They've got some online games,
or games as well.
The gaming side of it.
But one thing I always liked about it. It was something my dad used to comment because I used to collect it when I was younger. So when I was like 11 or 12, and he always used to say he thought it was really clever that you'd go into the store, you'd spend like 300 quid on a box of air, which was what he called it. You then go home and have to make the thing yourself. You've got to paint it yourself. And then once you've done all that, you can go back to the store where they've got all the boards and you can play it for free. And they'll just let you play it with your mates. But then you're surrounded by all the other stuff they want you to buy.
Yeah. And really, I suppose children, teenagers, and adults as well. But very difficult to resist.
I mean, children can't afford it, can they? Really?
Not anymore.
No, but so it just looks like a really, really well-run business. So revenue only grew 15% year on year. Yeah. So then the operating profit grew 60%.
Where do you think it's going next?
I don't know. So the market cap, it's only 3.3 billion.
Yeah.
Which is not huge. But then how big can it actually get? Because it is quite a niche product.
Yeah. And is it in the US?
I don't know.
Or is it sort of, because
70% of sales come from abroad and they've got 86 stores in North America.
Oh, really? Okay. So
so it's international. In fact, that's from 2012, so they must have way more now. But it's still a niche product, so I don't know how. So Hargreaves Lansdown has it as having a PE ratio of 44, but that doesn't take
punchy.
It doesn't take into account the current earnings yet, so that's just based on
That's
that's
so you
based
might
on the
see
full
that,
year
yeah.
results to May 2020, so it doesn't include the period to August. So I worked it out, and if you include the period to August, I think it brings it down to about 38, which is still pretty expensive. Yeah. I don't know how seasonal it is, but if you thought it could do operating profit of 45 million every quarter, and I'd assume there is some seasonality, but you get an operating profit of 180. So then if you assume that the only difference between the operating profit and then the earnings is just the tax, I think you'd get a PE of about 22.
Okay.
If it was able to do that every single quarter.
It's more reasonable.
It's expensive, but it is. I think it's a quality business.
Yeah.
The problem is it's estimating how much growth it can have.
And
as well, like if you look at it and you say, oh, well, like I said, revenue's only gone up by 128% in the last 5 years, but operating profits up by 400. Like they've been cutting costs, but
how much more efficient can they get?
So it's really they must be getting to the point where they need to grow it by increasing the revenue. And I don't know how big can it get.
What's it yielding at the moment?
Not very much, but the dividend policy is that they distribute what they call as truly surplus cash. So they have truly well, I don't know if they said truly, they might have just said surplus cash. The last financial year to May 20, the total dividends were 145p a share. So you're looking at under 2%.
Okay, and it's
£100 a share now.
Sure.
So I guess you'd say, well, the surplus cash will have gone up.
That's right.
But even if you say £2 a share, you're still looking at like a 2%. Yeah. So I suppose 2% is all right. It does seem pricey. That's my problem.
Okay, so again, something that it's on the watch list.
Yeah, the problem I've got with that is it's been on the watch list for quite a long time, but it keeps going up.
Well, trying to time the market.
Yeah, so I remember I looked at it when it was about 1,500 3 years ago, and it had gone up quite a lot to get to there, and I just thought, I'm not paying that. I think it's up like 7 or 8x since then.
Yeah.
It's a shame though, because it's genuinely it's a business I'd really like to own.
Yes, yeah. Okay.
I guess the argument is you should just buy the bullet and buy it.
Yeah, well, that problem is taken away because I'm, like I said earlier, in the index. Is
that all this is going to be every week? It's going to be me talking about shares and you just say, well, I'm just in the index.
We can cut this bit out.
No, we're keeping it in. I think one week, every week, you should buy one of the shares we talk about.
And see if I can outperform.
Exactly. If you had to buy one of Games Workshop or Peloton, which one would you go for?
I'd go Games Workshop for sure.
I think I would as well, yeah.
Well, and what do you think more broadly? I mean, just going back to the US tech. So we'd had the sort of huge rally, especially NASDAQ. And then sort of Tuesday, we saw it's, well, not quite correction territory, but it's pulled back a fair bit.
It has, but then if you look at where it's pulled back to, it's maybe like only pulled back to where it was in August.
Yeah.
It's just one of the things, isn't it? Like a stock can go up like 50 or 100%, and then it pulls back 10%, and everyone's like, oh.
Tesla's the one that's got the most attention. Any thoughts on that?
They're not. I don't have a particularly positive view of Tesla. I like the cars. I think it's a fantastic product.
Yeah, but the company itself and the stock.
Yeah, I wouldn't touch it with a 10-foot barge pole. I wouldn't short it either, though.
Quite a few people have got burned doing that.
Yeah, I wouldn't short anything, in fairness. But
okay, yeah. So.
To me, it's like my main issue with it is I think even if you accept that, I think it's priced to have pretty much 100% of the electric car market, and the electric car market is going to take over the world. That's the pricing, I feel like, when it's priced at like, what is it, like $400 billion.
Yeah, something along the.
Yeah, and I think that's not going to happen. But if you say, okay, it is going to happen, it is going to sell as many cars as are priced in. I still think it's still priced like a technology company, and the margin you've got building a car isn't cheap, so the margins aren't going to be great. Competitors' products are getting better. I think 4 or 5 years ago, if you wanted an electric car and you wanted a nice high-end one, you had to get a Tesla. Whereas now, like, you could get
Yeah,
a
and I
Jag.
suppose the sort of, some of the European companies, particularly the Germans, have started turning their attention more to the electric car market.
Yeah, so they're making nice cars that just look like the normal ones, like the BMWs, the electric ones. They look the same.
Yeah,
The Audi
yeah,
ones, they look, and they've now got a range that's a few hundred miles, so you can actually drive it.
Yeah, and arguably the general engineering sort of technology aside is potentially higher than the Teslas, and they've got 100+ years of car making experience.
I don't know about that, because Teslas are meant to be really, really well made. They're meant to be the safest. No, they are genuinely meant to be the safest cars on the road in terms of like passing all the safety tests and stuff. But I just think, in terms of like 4 or 5 years ago, if you wanted a high-end electric, you had to get a Tesla. Whereas now, you certainly, it'd be in the mix and you'd think about it, but it wouldn't be the only thing you were considering. But I think that's
true.
That'll put pressure on the margins, I think.
Yeah, and I think you've got at the other end of the market, you've got the Volkswagen, the ID coming through. So it's sort of they're equivalent to the Golf, so the sort of the mass market electric car. And I think it was a ground-up electric car as well, rather than sort of a conventional car with internal combustion converted to electric. And then with Porsche have come out at the other end with the Taycan, I think, which is
I've seen that.
Sort of rivaling the Model S in terms of performance. And again, it's got sort of the Porsche heritage behind it too. So I suppose have to see, but it's certainly a very expensive stock to buy right now.
Yeah. So like I say, I think it's priced to perfection, and even if you think it's going to sell the amount of cars that they're talking about, the margins, I just think they have to come down.
Yeah. And some of the institutions have been taking profits on it recently, I think.
I'd be very surprised if in 10 years' time it was worth more than it is now. So in terms of the FTSE itself, where's that?
Yeah. I think we're hovering around 6,000, I think, at the moment.
It's where it was in like 1998.
And I suppose you've got It could be.
Yeah, it was. It was at 6,000.
In
1998, it went up to a peak of 6,100. Pulled back in October of 98 to just under 5,000. And it reached a high in 99 of 6,800.
Yeah, no, that's right. But I mean, it's a different market to the States.
It's a bit like Japan, isn't it? Like a lost 20 years almost.
Yeah, and Japan has performed well over the last decade. I think after the S&P 500, I think it's been the second best performing index.
We're worse than Japan, aren't we?
I don't know where we are.
We've had a loss 20. Well, we've lost 22 years. We're on so far.
You've had I mean, it depends how you've invested, of course, and whether you've sort of selected some UK stocks. You do have some that have performed very well over that time. You have
probably had a 4% dividend a year, though.
Yeah, exactly. So you've had that sort of return, and it depends whether you've been sort of in sort of dollar cost or pound cost averaging with it as well. It doesn't
matter what you've been doing. If it was at 6,000 in 98 and it's 6,000 now.
Yeah, no, that's fair point.
Oh dear.
The FTSE 100, I should say, has been hit quite badly by Corona, and then the oil price crash as well. So you've got your oil super majors that still haven't recovered, and oil's $40 a barrel or so. So Shell and BP dragging the index down, and then the UK banking has also been hit pretty badly. So and house building and sort of general outlook is very uncertain at the moment.
Oh, well, that's cheery. I bought Rightmove.
Okay,
it's trading, according to Hargreaves Lansdown, it's at a PE ratio currently of about 40.
Would you say it's a UK? Would you describe it as a tech company?
I think I would, yeah. But it's worth mentioning that PE ratio is going to get absolutely hammered when the coronavirus results come out, because it's going to end up at some insane multiple. I think it might end up at like 100 or something, because profits will be down.
Okay.
So it reduced fees for the agents. So at first, I think it offered to like suspend the fees, or like, where it's like a holiday. Or I think it said you wouldn't have to pay it, but then it would still be payable. You just like, basically they'd let you like pay it late. So I think like they got a massive backlash to this. So it was like thought to be quite insensitive. And they basically got a monopoly anyway. So then they just said they were going to get rid of
it. Because you've got Zoopla, of course, but I don't know what sort of market share Zoopla compared with Rightmove.
I think it's only like 20%, like not even that maybe. The Zoopla website's not as good as Rightmove as well. I think it's just a bit more clunky.
No, I must admit, we're selling a house at the moment, and the Rightmove app is very slick. It's very easy to use. And how much do they typically charge the agents?
I think it costs about £1,000 a month to list there, and that's like per branch.
Okay.
So if you're a big national, so it's just absolutely huge.
It is the place that you think you must go to. It's the portal that everybody uses.
Yeah, I think you've got to be on there really. Historically, it's probably been at a PE ratio between 30 and 40, which in the UK is quite expensive. In the US, it's probably quite cheap. But I've always looked at that, and I thought if I'm paying 30 or 40 times earnings, then I want a good amount of growth. And I've always felt like the growth hasn't really been there. So,
and where is that growth coming from? I mean, they've got what, 80% of the market? Did you think?
Yeah, so I guess they can increase the fees, can't they? I suppose the fees,
that's right.
I don't know if the fees proportionately increase with the level of sales, maybe as well.
Sure.
And there probably are still agents that are on there, but yeah, they basically, it's probably quite mature now, so it's not really growing very much. So between the year end 2019 and year end 2015, revenue grew from 192 million to 289 million, so about a 50% increase. In that same period, the operating profit grew from 137 million to 213 million. So it's about 50. So it's probably moved in line. But then if you look at the actual margins, the operating margin, it's over 70%. It's just absolutely
it's
ridiculous.
massive. Yeah,
it's ridiculous. So when I actually looked into it the other week, I didn't expect the margins to be so high. So I compared it to Auto Trader, which is, I think, probably the most similar business listed in the UK.
Yeah.
And Auto Trader's operating margins are only 55%.
Oh wow! So it is significantly higher, and Auto Trader is already pretty big.
Yeah, so I just took the view that it's worth paying up for. So I just bit the bullet and bought it. So it does have a dividend as well, but the dividend so the dividend on a normal year looks like they've suspended the dividend at the minute, but you're looking at about 6p a share. So it's about a 1% yield. I think with the amount of money they're making, they could increase that substantially.
Again, is it just have UK exposure, or are there any plans in the company to expand either to Europe or the States?
So in the States, they do have their own equivalent. So there's one company called Redfin. I think they're primarily UK. We can have a look at their annual report and see if that lists. Yeah. What do you reckon the word would be? Search Control F International, maybe.
Always a good start.
Okay. So these are the full year results to December 20. So the word doesn't appear, international. What about overseas? Doesn't appear. I'll try market. Market appears 21 times. But that's just talking about the housing market. They're only talking about the UK market. I think they're just UK.
Yeah. No,
that's literally all they're talking about in the annual report. So so they're not, it doesn't look like they have any international presence. I mean, that's probably not a terrible thing, because you'd imagine by now, most of them, certainly in Europe, you'd expect most of them to have their own equivalents. And
no, that's right.
Yeah, so they probably are limited to the UK. So I think really it's just going to make money in the future by an increase in the amount of properties being turned over and sold each year, or just by rinsing the estate agents for more fees.
Yeah.
I think really whatever they charge, the estate agents just have to pay it really.
Yeah.
It's got a good balance sheet as well. It doesn't really have much debt at all. Yeah, it's just a quality company.
Books? Anything you're reading at the moment, Sam?
I have just started volume 2 of The House of Rothschild.
Is that another Neil Ferguson?
It is, yeah. So that was, he did it in 2 volumes because there was just too much to do in one.
Yes, no, he's got some good history of finance books out.
Yeah, so it was more one, it tied in quite nicely. So over the summer, I'd had a little project where I'd been reading about the The robber barons in America, so the industrial age entrepreneurs, so like Carnegie, Rockefeller. So I've read books on, I think I did all of them except JP Morgan, who I do intend to do. I'm just saving it because it's the last one, actually. But yeah, one that tied in quite nicely was the Rothschild family. So I've got the books on that. And that is really, really interesting. So it's set in like the 1800s, which is when they were in the most dominant period. And they were just awesome. Like they were 10 times the size of their nearest rival. But yeah, it doesn't really relate to investing that well. What about you? What are you reading at the minute?
At the moment, I have come across Rob Dix. No, so he's a property investor, UK based, and it's his sort of introduction to buy-to-let property investing. Enjoying it so far. I'm not sure when it was published actually, but it's talking a lot about different models you can get in terms of buy-to-let and sort of different approaches suiting different people, and how you might use leverage to maximise your returns. So probably one to be cautious with.
Would you get a buy-to-let?
At the moment, I think from what I've read about property investing, something that I haven't done at all before, very difficult to make, profits. And you've got I think the tax regime has become much more strict, and not favouring the landlords quite as much as it perhaps, or being quite as generous as it used to be. So it's not something that I'm sort of looking to do in the near term, but certainly something I'd like to learn about more. So if I do make the plunge, I'd be better informed on it.
I think that's everything, isn't it?
Okay.
Unless there's anything else you want to add.
No, I think we've covered a fair bit for the first podcast.
Yeah. We'll see you next week, folks.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.